You own a bank. Not a metaphor, not a fintech app with the word bank in the name, not a credit union or a lending platform or a digital wallet that processes payments on someone else's infrastructure. An actual bank. A federally chartered financial institution with a routing number, an FDIC insurance, and a physical branch and a vault, and the specific legal authority to take deposits from the public and lend them out at interest. You are going to need a moment to understand what you actually have. Because most people who think about owning a bank think about the lobby, the marble floors, the teller windows, the safe, the visual vocabulary of banking that movies and television have installed as the image of what a bank is. That image is not wrong exactly, but it is approximately as useful for understanding what you own as knowing what a plane looks like from the outside is for understanding how flight works. What you actually own is a license. A license to do something that almost no other type of business is legally permitted to do. A license that the federal government grants through a process that takes years and costs millions of dollars and requires demonstrating to multiple regulatory agencies simultaneously that you have the capital, the expertise, the governance structure, and the business plan to operate a financial institution responsibly. That license is the most valuable thing you own. More valuable than the building, more valuable than the deposit base, more valuable than the loan portfolio. The license is what makes all of those things possible and what separates you from every other business that moves money around and makes money from doing it.
How you actually make money. You make money from the spread. This is the foundational reality of banking economics, and it is simpler than most people expect. You take money in from depositors at one interest rate. You lend that money out to borrowers at a higher interest rate. The difference between what you pay depositors and what you charge borrowers is your net interest margin. It is the engine that powers everything else. Your depositors, the people who open checking accounts and savings accounts and certificates of deposit at your institution, are paid somewhere between 0 and 5% annually on their balances, depending on the account type, the rate environment, and how aggressively you are competing for deposits in your market. Your borrowers, the businesses taking commercial loans, the families buying homes with mortgages, the consumers carrying credit card balances, are paying you somewhere between 4 and 25% annually, depending on the loan type, the borrower's creditworthiness, and the term of the obligation. The spread between those two numbers, even after operating costs, loan losses, and regulatory compliance expenses, produces a return on equity that, for a well-run bank in a normal rate environment, typically falls between 10 and 15% annually. This is not the most spectacular return available in financial services. It is one of the most consistent. Banks that are managed competently do not have great years and terrible years the way cyclical businesses do. They have good years and slightly less good years, and the consistency of the earnings compounds over time in a way that makes banking one of the most durable wealth-building businesses available. What makes the spread powerful is the leverage. You are not lending your own money. You are lending your depositors' money. Your own capital, the equity you put into the bank when you chartered it, represents approximately 10% of your total assets. The other 90% is funded by deposits that other people placed with you. You are deploying $10 of your own capital to control $100 of assets and earning the spread on all 100. That leverage is why banking is one of the most profitable businesses per dollar of equity when it is run well. It is also why banking is one of the most dangerous businesses per dollar of equity when it is run badly. The same leverage that amplifies returns when the loans perform amplifies losses when they do not. The regulatory reality. You did not fully understand what you were getting into with the regulators until you were in it. You have multiple regulators, not one, multiple. The Office of the Comptroller of the Currency if you chose a national charter, the Federal Reserve, the FDIC, your state banking regulator. Each of these agencies has examination authority over your institution. Each of them can walk into your bank at any time, without notice, without an invitation, without your permission, and examine your books, your loan files, your compliance programs, your capital ratios, your risk management systems, and your governance documentation. The examinations happen on a regular cycle, and they produce ratings, Camel's ratings, named for the 6 categories they evaluate that determine how much regulatory scrutiny you operate under and what actions the regulators can take against you if the ratings fall below acceptable levels. Capital adequacy, asset quality, management capability, earnings performance, liquidity position, sensitivity to market risk. 6 categories, each scored, combined into an overall rating that follows your institution like a credit score and influences everything from your ability to open new branches to whether the regulators allow you to pay dividends to your shareholders. You quickly learn that operating a bank means operating in continuous dialogue with people who have the legal authority to tell you what to do with your own business. This is not a negotiation in the conventional sense. The regulators do not need your agreement to require changes to your lending practices, your capital levels, your management team, or your business strategy. They have enforcement tools that range from informal guidance to formal written agreements to consent orders to cease and desist orders to the ultimate sanction, receivership, which means the FDIC takes over your bank and your ownership is effectively extinguished. Most banks never face the most severe enforcement actions, but the knowledge that the framework exists, that your business can be taken from you if the regulators determine that it is being operated unsafely or unsoundly, is present in every decision you make as a bank owner in a way that has no equivalent in almost any other industry.
The deposit franchise. Here is what you eventually understand is the most valuable thing you own that is not on your balance sheet: your deposit franchise. Deposits are not just funding, they are relationships. The checking account customer who has been with your bank for 12 years is not just a source of zero-cost funding. They are a customer whose inertia, trust, and daily financial habits make them extraordinarily difficult for a competitor to take away from you. They have their direct deposits set up at your routing number. Their automatic payments run through your system. Their debit card is in their wallet. Moving all of that to a different bank is a friction-laden project that most customers never complete, even when a competitor offers them marginally better rates. This stickiness of deposits, the behavioral economics of financial relationships that makes them far more durable than they should be on a purely rational interest rate comparison basis, is the hidden engine of bank profitability. You are earning a spread on deposits that your competitors cannot easily steal from you because your customers are anchored to you by habit and history.
The deposit franchise also compounds. Every year a customer stays with your bank is a year of transaction data, relationship depth, and cross-selling opportunity that a new customer cannot provide. The customer who opened a checking account with you in 2005 and also has their mortgage, their business account, and their home equity line with you is generating revenue from 5 different relationships simultaneously and costing you almost nothing in acquisition expense because the acquisition happened 20 years ago. Building a deposit franchise takes decades. Destroying one takes months. This asymmetry, the slow accumulation of valuable customer relationships, and the rapid fragility of those relationships when trust is violated is one of the most important things you understand about what you own and why protecting it with your operating decisions matters beyond just the immediate financial consequences. The lending business. Your loans are your assets. This sounds obvious until you sit in a credit committee meeting and approve a commercial real estate loan and understand viscerally what it means that this piece of paper, this promise from a borrower to repay you over 25 years at a specific interest rate, is now sitting on your balance sheet as an asset that you will be carrying through every economic cycle that occurs between today and its maturity date. You are in the business of predicting the future. Not perfectly, not with certainty, but with enough accuracy that the interest income you collect from the loans that perform exceeds the losses you absorb from the loans that do not, and that the excess, after operating costs and regulatory compliance and the compensation of the team that underwrites and monitors the portfolio, produces the return on equity that your shareholders expect.
The credit underwriting process is the core skill of banking. It is the thing that separates the banks that generate consistent returns across economic cycles from the banks that look excellent in good times and catastrophic in bad ones. Good underwriting means understanding not just whether a borrower can repay today, but whether they can repay when the economy has turned, when their industry has contracted, when the collateral supporting the loan has declined in value, when the circumstances that made the loan attractive at origination have changed in the directions they always eventually change. You learn quickly that the most expensive loans are not the ones with the highest loss rates when they default. They are the ones that looked like they would never default, and then did. The loans that were approved because the borrower was successful and the collateral was strong and the relationship was important, and nobody in the credit committee was willing to say the thing that needed to be said about the structural weakness in the cash flow projections. Those loans are the ones that cost you the most because they were approved in the largest amounts and held with the most confidence and monitored with the least skepticism.
What owning a bank actually teaches you about human nature, but it does. Every loan application is a story that someone is telling you about themselves and their future. Every deposit account is a person's financial life passing through your institution on its way to wherever it is going. Every delinquent borrower is a human being in circumstances that the underwriting model did not anticipate, and that your collections team is now navigating with a combination of legal authority and basic human judgment about what is possible and what is not. You learn that money is not abstract in the way that financial theory makes it seem. It is the most concrete thing most people deal with on a daily basis. The decisions people make with it, the emotions they attach to it, the stories they tell about it, and the ways they behave when they have it and when they do not, all of that passes through your institution every day, and none of it appears in the financial statements.
What appears in the financial statements is the net interest margin, the provision for loan losses, the efficiency ratio, the return on assets, the return on equity. These numbers are real and they matter, and you watch them carefully because they tell you whether the machine is running the way it is supposed to run. But the machine runs on people. On the depositor who trusts you with their savings, on the borrower who is betting their business on your willingness to extend credit, on the employee who shows up every day and handles other people's money with the care and integrity that the whole system depends on. You own a bank. What you actually own is trust at scale. The license lets you operate. The trust is what makes the operation worth anything. Do not forget which one is harder to rebuild. If this video gave you a new way of thinking about how banks actually work from the inside, subscribe to Cody Finance. New videos every week.